Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Firefly Aerospace Inc. Annual Report. Firefly Aerospace Inc. provides a range of businesses and services to its customers. At the core of their offerings are integrated launch and space services technology that enables launch, transit, and operations in space. This includes Alpha, a responsive launch service designed for quick and efficient access to space. In addition to launch services, Firefly offers specialized vehicles tailored to specific needs. The Eclipse is a medium-lift launch vehicle suitable for larger payloads, while the Blue Ghost is a lunar delivery and operations service that enables customers to transport goods and conduct operations on the Moon. The company also provides space maneuverability and servicing capabilities through its Elytra service. This allows customers to perform complex maneuvers in space and maintain their spacecraft over extended periods. Furthermore, Firefly offers Ocula, a lunar imaging service that provides high-resolution images of the lunar surface. Overall, Firefly Aerospace Inc.'s diverse range of services caters to both national security and commercial customers, solidifying its position as a leading player in the space technology industry. Firefly Aerospace Inc., market capitalization of $4 billion, is materially smaller than most of its industry peers of roughly $6 billion. Firefly Aerospace Inc. trades at a higher price-to-book ratio of 3.11 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 288% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of key metrics and events. On the growth side, acquisitions have played a significant role, with notable deals including SciTech Innovations, LLC, and Spaceflight. The expansion of orbital flight services has also contributed to revenue growth, as well as an increase in customer orders and signed sales agreements. Additionally, the recognition of revenue from remaining performance obligations and the acquisition of contract assets have driven growth. On the decline side, a notable decrease in other revenue has been observed, with a 100% drop from 2023 to 2025. However, it's worth noting that this decline is isolated to one specific category, while other areas such as launch revenue and spacecraft solutions revenue have seen significant increases. Overall, these metrics suggest that the company's growth strategy is focused on expanding its services and acquiring new assets, which has driven revenue growth in key areas. The net income of the company experienced a significant decline over the 3-year period from 2023 to 2025. The net income decreased from -$135.5 million in 2023 to -$231.1 million in 2024, and further dropped to -$298.3 million in 2025, indicating a substantial decrease of $104,335 from 2024 to 2025. The decline in profit margins was attributed to various factors. One major reason was the increase in operating expenses and capital expenditures, which led to decreased profit margins. Additionally, potential trade disruptions, tariffs on imports, and market uncertainties further contributed to the decline in profit margins. The company's dependence on competitive bidding processes for contracts also added to the uncertainty surrounding its revenue growth. The reasons behind the decrease in net income and profit margins were multifaceted. Increased costs for components, shipping, warehousing, and inventory played a significant role. Uncertainty about global economic conditions, shortfalls in available external R&D funding, and dependence on competitive bidding processes also contributed to the decline. Furthermore, government shutdowns and changes in U.S. government priorities and spending levels posed additional challenges to the company's financial performance. The net income and profit margins of the company experienced a significant downturn due to various internal and external factors. The increase in costs, uncertainty about global economic conditions, and dependence on competitive bidding processes all contributed to the decline. As a result, the company must adapt to these changing circumstances and explore strategies to mitigate the impact of these challenges on its financial performance. The company's financial performance indicates a significant milestone. According to the latest data, the company has successfully transitioned into generating positive operating cash flow. This achievement signifies a substantial improvement in its ability to manage expenses and generate revenue. The shift towards positive operating cash flow is a testament to the company's efforts to optimize its operations and improve profitability. This development is particularly noteworthy as it suggests that the company is now able to cover its operational costs without relying on external financing. As a result, the company has gained greater financial flexibility and stability, enabling it to invest in growth initiatives and pursue new opportunities. Overall, the generation of positive operating cash flow marks a significant step forward for the company, underscoring its improved financial health and prospects for future success. The company's debt level has undergone significant changes over the past few years. Initially, it increased from $125 million in August 2025 to $260 million in November 2025, only to be repaid in February 2026. However, by December 31, 2025, the debt level had risen again to $288.5 million. Furthermore, total liabilities also saw an increase from $415,372 to $634,995. In contrast, interest expenses have shown a mixed trend. While there was a decrease of $1,407,000, 6%, in interest expense from 2024 to 2025, it is worth noting that the same figure increased by $14 million from 2023 to 2025. This inconsistency suggests that the company's interest expenses are not as straightforward as they seem. Management statements on the company's outlook and strategy are optimistic. They believe the company is well positioned to serve growing demand in the space market, citing opportunities for significant growth through hypersonic payload testing capabilities and expansion into international markets. The company plans to continue forging strategic partnerships with industry leaders and capitalize on the shift towards firm fixed-price contracts. This suggests that management is focused on leveraging the company's strengths to drive future success and growth. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the most notable ones include the purchase of SciTech in October 2025, which is supported by a significant investment of $255.7 million drawn from the revolving credit facility. This acquisition highlights the company's commitment to expanding its capabilities and resources through strategic partnerships. The absence of any divestitures mentioned in the summary suggests that the company has been focused on growth rather than downsizing or restructuring its operations. However, it is worth noting that a separate entity, Industrial, acquired Firefly in 2022, indicating that some business units may have been spun off or sold to other companies. Nonetheless, this transaction appears to be an external development rather than a direct divestiture by the company in question. The company has a history of paying dividends to its shareholders. In fact, it has paid cash dividends on multiple occasions, with the most recent payment being $5 million on August 28, 2025. Additionally, the company has also recorded accretion of dividends for its preferred stock, which is essentially an accounting entry that increases the value of the shares. Furthermore, the company has also engaged in share buybacks through the accretion of dividends for its preferred stock. This means that instead of paying cash to redeem the shares, the company records the redemption value as an increase in the value of the shares. For example, in 2025, the company recorded $22.4 million and $13.2 million in accretion for Series D and C preferred stocks, respectively. Concerns about inventory buildup and supply chain disruption, the the company's operations are threatened by several potential disruptions in its supply chain. Manufacturing delays, supply chain delays, and unavailability of reliable launch opportunities with suppliers, page 19, could hinder the production of critical components. Furthermore, uncertainty regarding global trade and central bank monetary policy, as well as instability in the global credit markets, may lead to tariffs and retaliatory measures that impact the company's operations. The increased demand for semiconductors has caused a global shortage, resulting in uncertainty about suppliers' timely delivery, page 25. Labor union actions at suppliers could also disrupt supply chains, while governmental regulations or regulatory approvals may impact operations. Tariffs on certain imports could lead to supply chain interruptions for equipment, and interruption or failure of infrastructure could hinder daily operations. The company's financial results are also vulnerable to factors outside its control, such as the cost of raw materials or supplied components critical for manufacture and operation of space products or launch systems, page 31. The inability of customers to obtain financing for purchases from the company may further exacerbate these risks. To mitigate these concerns, the company may require additional funds to support business growth, including expanding inventory. That concludes the financial summary for Firefly Aerospace Inc. Feel free to comment below, and I will be happy to answer them when possible.